Good morning, everyone. We will just wait for 1 more minute before we get started, just to allow more people to join us. Good morning again. Welcome, everyone, and thank you for joining us for today's webinar. My name is Lara Malab, and I'm the Head of Business Development and Marketing at RAK ICC. As we may all know, the UAE has introduced a corporate tax law following the issuance of Federal Decree number 47 of 2022 on the taxation of corporations and businesses, and therefore corporate tax will apply to a defined taxable person. In this webinar, we will provide you with an overview of the principles of corporate tax and practical applications using examples. We will also try to cover some of your questions based on the information currently available on the corporate tax applicability. Please also note that further guidance and clarification is expected once the appropriate cabinet resolution is issued, and we will assess the position of the RAK ICC entities in relation to the corporate tax and keep you updated once the cabinet resolution is released. But before we start, let me have a quick introduction to RAK ICC for those who aren't familiar with us. So RAK International Corporate Center is a modern world-class company registry responsible for the registration and incorporation of international business companies and operating in full compliance with international standards and best practices. RAK ICC is well positioned as a premium international jurisdiction, offering a variety of services that provide clients with flexible options to establish their corporate entities in a way that best suits their needs, whether for international businesses or private wealth needs. RAK ICC entities are best suited for investment and trading, holding purposes, international tax planning, wealth management, securitization, asset protection, and succession planning. The RAK ICC regulations are set in accordance with the common law and international best practice, with access to independent judicial systems. Companies at RAK ICC are established through a network of registered agents, many of which have an international presence, hence providing the registry with a global reach. Flexibility, convenience, legal certainty, and effectiveness are just some of the key advantages. With a variety of company types and legal structures, clients can be assured that their requirements will be met in a manner that best suits their needs within an attractive tax regime effective in the UAE. Now we have a good registration numbers for this webinar, so thanks again for joining us, and I'm very delighted to welcome our speakers from MCA Management Consultants. Just a little housekeeping before we get started. This webinar is being recorded and shall be shared with you later and will be posted on our website for those who were unable to attend it. If you have any questions during the presentation, please type them in the question box in your Zoom control panel below. We will bring them up during the Q&A session at the end. And in case we were running out of time, we'll be responding to your questions individually following the webinar. I'm delighted to have Alan, our registrar, Alan Bugord, joining me from RAK ICC to address any questions related to the registry, and we'll bring up the questions that you will raise at the Q&A session. We also have with us Girish Chan, who is a senior partner at MCA Management Consultants with over 25 years experience in finance and internal audit. He held senior managerial roles in diverse industries. Girish is heading the MCA Gulf compliance practice covering corporate tax, VAT, ASR, AML, UBO, and has a valuable contribution to Khalij Times on VAT topics. We also have Nirav Shah, who's a senior partner at MCA Management Consultants with over 9 years experience of subject matter expertise in corporate and international taxes. Nirav gained high professional tax expertise by working with Big Four audit firms, assisted various MNCs with respect to tax advisory, compliance, litigation, support services, and many more. Now, without further ado, I will pass over to Alan before we turn the time over to Girish. Alan, over to you.
Thank you, Lara. And I'm going to very briefly just add my welcome to everybody and thanks for joining. I just wanted to say a few words of appreciation for Girish and Nirav. We know that this is going to be a very useful session for you. You'll be pleased you won't be hearing much from me today. You'll hear more from me next week if you're attending our Meet the Registry event in Dubai. But very timely that we have this tax discussion, even though we won't have all of the answers yet. We know that. But nonetheless, very useful to be able to get an update. We're very delighted to facilitate it and extremely grateful to Girish and Nirav for offering to help. So very much keen to hear from you and pass over to you for your presentations. Thank you.
Girish, you're on mute. Thank you.
Yeah, thank you, Alan. It's an absolute pleasure to basically address the customers of RAK ICC. Obviously, when we talk about the offshore entities, I think the big question comes in is that effectively, we have been possibly, given, or at least the belief is that, tax will not apply as such, right? So now, of course, with the UAE corporate tax coming into play, right? So there is I think it's a landmark kind of legislation, and primarily, it has got a lot of implications. So over the next half an hour, what we'll try and do is basically explain the legislation as it is available in the public domain. Obviously, certain key definitions which are there in the corporate tax law, we will dwell on it, and primarily, based on that, try to develop an understanding how does it apply for the RAK ICC entities. If you can share the presentation. Yeah, we'll move to the next slide. Yeah, bring up the whole one. Okay, so primarily our agenda is very simple. We will cover the UAE corporate tax as such, considering of the basics, the provisions in the UAE corporate tax law, and obviously, one of the key elements is in terms of how do we prepare for the corporate tax. So this is a brief agenda that we have. Next slide, please. Good slide. Yeah. So if you look at the chronology of the events as far as the corporate tax is concerned, okay, so we basically started with the announcement of the introduction of corporate tax on 31st of January 2022, right, which effectively gets set the ball rolling in terms of the corporate tax implementation. Subsequently, on 20th of April, we had the release of a public consultation document where I think, primarily that was a document possibly giving a fair bit of clarity of how the corporate tax was going to be rolled out. Obviously, this was a document which was, kind of inviting the comments from the public on the various provisions of the corporate tax law. right? So that was something which was followed with the actual corporate tax law on 9th of December 2022, right, which is referred to as the Federal Decree Law 47 of 2022, right? Now, this particular corporate tax law, as with any legislations being introduced, I think you always have the base, or like they say, if you were to look at a building, right, the basic structure of the building being laid out. So I would describe the corporate tax law as the structure of the corporate tax legislation being laid out. So that is what we have seen. So effectively, it is in black and white. Obviously, because it's a structure, there is a lot of stuff that needs to be done. As in a building, you would have to build up the basically the interiors and all those, right? So those are kind of expected to come along the way. Okay, we could take guidance from the public consultation document in terms of what is likely to follow, right? But like they say, if you want to implement something, you need it in black and white. So currently there is only a direction on certain aspects. Okay, and that is where you might find that we are generally talking that the clarity which we are currently having is possibly in our estimate around 60 to 70%. And, we expect that to be further clarified. The other, fact which is there is that, unlike the VAT legislations, where we had one executive regulations kind of here laying down, the various provisions in detail, maybe in context of the corporate tax, the expectation is that they will be in a form of a series of cabinet decisions. In fact, one such cabinet decision is already been announced, okay, where they have clearly laid down in terms of what is the limit that is going to be applied for the, for the corporate tax applicability. Yeah. So, basically, I think just pardon me if there are people who are knowledgeable about corporate tax, but I think I just intend to cover all the audience. So primarily when we talk about the corporate tax, it's a form of direct taxation. Okay. And very simply put is that as far as entities are concerned, there is a straight impact on the bottom line. And what we are saying currently is that impact is kind of 9%. Why it is being introduced, I think, I'll not dwell too much into it, but I think it is very clear that in the context of what is happening in the worldwide and with the OECD Pillar 2 kind of regulations, so it was a question of when rather than why. Primarily, I think one important aspect which we need to distinguish as far as compared to VAT is that, like we're saying, it's a direct form of taxation. Effectively, when we talk about VAT, if the companies are efficient, there is no impact on your bottom line, right? So unlike that, in the context of the corporate tax, there would be an impact on your bottom line. Okay. Just for clarity, in terms of when is it effective, it is effective for financial year starting on or after 1st June 2023. Right. So whenever we use the term financial year, so what it would basically mean is that as far as the corporate tax implementation is concerned, it is not going to be uniform for all the entities. It would depend largely on the financial year. Most of the entities in the UAE generally follow the financial year of Jan to December. So for such entities, primarily the financial year of applicability will be from 1st Jan 2024. And the year would be from Jan 2024 to 31st of December 2024. Of course, there are some entities which have possibly a year of, say, April as such, April to March. In case of such entities, the effective year for the implementation will be from 1st April 2024 to 31st of March 2025. Okay, like I mentioned earlier, so now we have the in the cabinet decision be specified in terms of what is the limits for corporate tax. So what we are talking here is that if the net income is below 375,000, basically the taxation rate will be 0%. Okay, and for basically the income which is above 375,000, you will apply a 9% taxable rate. Okay, now also in line with the the UAE adoption of the Pillar 2 of OECD guidelines. So what would happen is that in case of MNC entities, largely these are entities which are having turnover in excess of euro 750 million. In case of such entities, maybe an higher rate of tax will be applied. Currently, there is no clarity. I think it is in terms of the phased manner of implementation of Pillar 2. So now we'll take an example of possibly where we have a net income of 500,000, net taxable income of 500,000. What would apply in such a case is that the first 375% would be taxed at 0%. The balance 125,000 would be taxed at 9%. So what we would get is effectively the net tax payable is 11,250. I will now hand over to Nirav to take us through the details of the corporate tax law. Over to you, Nirav.
Thank you very much, Girish. Now we will delve into the specifics of the corporate tax law. And the first thing which we are going to discuss about is a residential status. Basically, whether a person is a resident or a non-resident is of utmost importance because the quantum of income which will be subject to tax in the UAE will differ for a resident and will be different for a non-resident as well. So who all are resident and who all are non-resident? So for a resident person, any entity or a juridical person, that means an entity incorporated, established or recognized under the UAE legislation will be considered as a resident. Another category of the person is that any entity which is incorporated outside the UAE, but effectively managed and controlled from the UAE, then that entity, though incorporated outside the UAE, will be treated as a resident for the purpose of UAE corporate tax law. And the third category is any natural person doing any business or business activity in the UAE. Now, these three categories of person would be considered as a resident in the UAE. Now, for what will be the taxability of those person if treated as a resident? So for an individual person, only the income from business or business activity would be taxable in the UAE. Whereas for resident juridical person, that means a legal entity, entire worldwide income would be taxable in the UAE. So now here it is, once we have understood the resident, we will also now understand who all are non-residents. So any person who is not a resident, that means he doesn't fall into the three category which we discussed, and having a permanent establishment in the UAE. Now, permanent establishment, we'll understand this with an example, assuming there is an entity which is incorporated outside the UAE and operating in the UAE or conducting business in the UAE through a branch or a factory or a warehouse, then that factory, warehouse or a branch will be considered as a permanent establishment of that foreign entity in the UAE. So any non-resident person having a permanent establishment in the UAE, any non-resident deriving UAE sourced income. This is very important terminology. We will discuss this later on. But effectively, it is any income which that non-resident or overseas entity or a person is earning through a person resident in the UAE, or any income which is connected to any assets, properties, or other tangible or intangible things situated in the UAE, then possibly that income could be treated as a UAE sourced income. And the third is non-resident having a nexus in the UAE. Now, what is nexus? They have not defined as of now. It is expected that the cabinet decision will specify what is a nexus for a non-resident in the UAE. But in general understanding, one can take an example that if any non-resident is having any connection or any kind of link in the UAE through which that person is conducting its business, then that can be considered as a nexus. So for a non-resident, only income which is earned out of that permanent establishment or that UAE sourced income or income which is connected to nexus, only this income would be taxable in the UAE. So this is the biggest difference. If we see, if we go back to the resident also, the worldwide income would be taxable in the UAE. However, for a non-resident, only the income which is, you can see effectively, which is connected to UAE business would be taxable in the UAE. Now, the important question which comes to us is that whether an offshore entity will be treated as a resident or a non-resident. So here, as we see the second bullet on the left-hand side, the juridical person incorporated, established, or recognized under the UAE legislation. So any offshore entity which is established, recognized, or incorporated under UAE legislation would be treated as a resident. Now, there is a possibility that it will be treated as a resident. However, we will have to wait for the cabinet decisions and FAQ to be issued, which will give more clarity on this aspect. Moving on to the important, you can say the two terminologies, business and business activity, and the UAE source income. First, we will speak about what is business and business activity. This is relevant because the tax is being, you can say, levied on the business or business activity of a person. Now, for an individual, it is very important because individuals will be taxed only on the business income. In case they have any other income which is not relating to their business, it will not be subject to tax in the UAE. For a company, it's a general presumption that whatever activities the company is undertaking would be considered as a business activity, and accordingly, entire income would be taxed as a business income. Now, what is the meaning of business and business activity? So in a nutshell, it is that any activity which a person is undertaking in terms of industrial, commercial, professional, vocational, etc., which is on a continuous basis and for the purpose of earning profit out of it. If that is the motive, then the activity will be considered as a business or business activity. And accordingly, that would be subject to UAE corporate tax. Now, what is UAE sourced income? We understood in the earlier slide that for a non-resident, this is very critical or important, because if the income is derived from a UAE source income, it will be subject to taxation. So now what are the income which may fall under the category of UAE source income? First of all, we will also understand which kind of income can qualify as a UAE source income. So any income which a non-resident is deriving from a person resident in the UAE, or from the permanent establishment of UAE permanent establishment of any other non-resident, and any activities which are performed or assets located or capital invested in the UAE, if the income is derived from this kind of activities or a person, then it will be considered as a UAE sourced income. And which kind of income would fall under this category? We have an example there: sale of goods, provision of services, performance of contract, movable or immovable, any income relating to movable or immovable property, you can say use of any rights or any property, etc. So if we see here, almost all kind of income which are related to UAE assets, whether movable or immovable, or which generate from dealing with a UAE resident, can fall under the ambit of UAE sourced income. And if it is a UAE sourced income, the income would be subject to tax as per the UAE corporate tax law in the hands of non-resident. And we have to understand these are the examples which we have mentioned so far, that sale of goods and provision of services. It's an inclusive definition. So there may be other category of income also which may be considered as a UAE sourced income. Now, the important question which comes to us, whether an income of an offshore entity will be treated as a UAE sourced income. So answer will depend upon which kind of activity a offshore entity is undertaking. If we are doing an activity, generating an activity with dealing with a resident in the UAE, or a UAE of a non-resident, and if we are doing an activity which is mentioned as an example, a sale of goods, provision of services, performance of contract, there is a possibility that income will be treated as a UAE source income and accordingly would be taxed in the UAE. Here again, we will clarify one thing. This UAE source income is relevant for a non-resident. In case an entity is treated as a resident, all income is taxable. So accordingly, the bifurcation of whether it's UAE source income or not will not arise. Moving on to next topic. So which are exempt persons? So there are person which are generally a person undertaking a business is a taxable person, but there in the corporate tax law, there is a specified, you can say, persons who all are not taxable, and those persons are called as exempt person. Now, which kind of person are not taxable or not covered in the ambit of UAE corporate tax law? So those are government entities or their departments, any entity which is governed by, you can say, which is controlled by the government and doing a sovereign or mandated function for the state, basically UAE. Any person undertaking a business of extraction of natural resources or any non-extraction related activities relating to that natural resources, which is subject to tax at emirate level. Qualifying public benefit entity, in a simple term, it would be a charitable institution or a trust which is conducting its activity for the purpose of social welfare or public welfare, would be a qualifying public benefit entity. Here also, we are expecting a cabinet decision to specify which all active entities will be considered as a public qualifying benefit entity. Qualifying investment funds. Investment funds fulfilling certain conditions will also be exempt from the UAE corporate tax law. Public or private pension, social security funds, that is also exempt from corporate tax law, subject to meeting certain conditions. And last, any person who is controlled by certain exempt persons, then that entity also will be considered as an exempt person. Now, it is important to note that if we see this category of, you can say, exempt persons, majority of the entities, or you can say, if they are doing non-business activity or business activity which are subject to emirate level taxation, those only are excluded. In case this kind of person are doing other activities which are in the nature of business or for a profit motive, then even this kind of entities would be subject to UAE corporate tax law. Moving on to our next topic, what is exempt from the UAE corporate tax law? So generally, business and business income are taxable, but there are certain incomes which are not taxable as per UAE corporate tax law. Which are those incomes? So first is dividend or any profit distributions received from a resident legal person. Resident legal person, for an example, could be any UAE entity, UAE company. If a person is receiving a dividend or any kind of profit distribution from a UAE company, then that would be exempt and accordingly will not be subject to tax. Any dividend or other profit distributions received from a participating interest in a foreign legal person. So foreign legal person here means a company which is incorporated outside the UAE. And if I'm receiving a dividend or any other profit distribution from a foreign company, I will have to additionally satisfy the condition of participating interest. Then what is the participating interest? It is nothing but I am having a shareholding in that entity of 5% or more. I hold that, I'm holding those shares for more than 12 months, or I intend to hold it for 12 months or more. And that foreign company or an entity is subject to tax at least 9% in that respective country. If these conditions are satisfied, then whatever shares I'm holding or interest I'm holding would be qualified as a participating interest. And if I receive any dividend or the profit distribution from that foreign company, then that would be exempt from the UAE corporate tax law. Third category of income is certain other income like capital gains, foreign exchange gain, etc., which are relating to a participating interest from either a legal person, which is there in the UAE legal person, or a foreign legal person. Both. If I fulfill the condition of participating interest, then only it will be subject to exemption. Fourth category of income is income of a foreign permanent establishment. Now, what is foreign permanent establishment? So we'll understand this with an example. If there is a UAE company having a branch in UK or a USA, then that UK or USA branch of a UAE company would be considered as a foreign permanent establishment. Now, UAE company will have two options. Since it's a branch, UAE company ideally is required to include the income of that US or UK branch in its income, total income for the purpose of UAE corporate tax law and pay tax on the same. However, UAE company will have an option to take a claim and exemption by which the income which is generated by that US or UK branch will not be included for the purpose of UAE corporate tax law, and that income will not be subject to tax in the UAE. However, that exemption can only be claimed if that US or UK branch is at least subject to tax at 9% in the respective country. If I can fulfill that condition, then yeah, this option I can claim this exemption. The fifth category of income is any income derived by a non-resident from operating or leasing of aircraft or a ship in an international transportation. So this income is also not taxable in the UAE. Here, the important question comes to us is whether what will be the taxability of income generated from investment management or real estate activities. So this, first of all, to you can say determine the taxability of this income, we will have to first understand whether we are a resident or a non-resident. And based on that, we will have to see whether the income which I have generated is falling into the exempt category. If it's not falling into an exempt category, it may be taxable. The taxability, again, I'm repeating, it will depend upon whether you are a resident or a non-resident. Because for a resident, world income would be taxable. For a non-resident, only the income which we saw, that income from a PE, UAE sourced income, and income from the nexus in the UAE would only be taxable. This will require a little bit analysis to come to a conclusion whether for a offshore entity, whether income is taxable in the UAE or not. Moving on to free zones. As we all know, free zones have a special importance in the UAE. And accordingly, there are certain, you can say, benefits which are given to a free zone entity as well. So first of all, free zone entity will get benefit only if it's a qualifying free zone. What kind of benefits are there? We will see later on. First, we will understand what is a qualifying free zone. So any free zone entity so there are conditions which needs to be fulfilled, and those conditions are any entity having maintaining adequate substance in the free zone entity, maintaining adequate substance in the UAE, derives qualifying income. This is a very important thing, qualifying income. What is qualifying income has not been specified in the law as of now, but we get some clue from what was mentioned in the public consultation document, which we'll see in the next slide. So, okay, so a free zone entity deriving, having adequate substance, deriving a qualifying income, that entity has not made an election to be subject to corporate tax in the UAE and maintains the transfer pricing, you can say complies with the transfer pricing rules and does the necessary compliances. If these conditions are fulfilled, then a free zone entity will be qualifying as a qualified free zone person. And if it is earning a qualifying income, the tax will be 0%. So effectively, there will not be any tax. Any income other than qualifying income will attract the 9% corporate tax law. Here, we will also have to note one important thing. In the basics of the corporate tax law, we learned that there is the income in excess of 375,000 dirham would be will be subject to tax at 9%. But so far as the free zone entities are concerned, the threshold is not there. So if there is a qualifying income, you straightforward, you are not subject to tax on that income. But if you are having income other than qualifying income, without any threshold, that would be directly subject to tax at 9%. And the third category of, you can say, entity, which are a part of, you can say, multinational corporations, if they are covered by Pillar 2 rules, then that would be subject to tax at separate rate. But however, presently, since the Pillar 2 rules are not implemented in the UAE, those entities will continue to be taxed at 0% and 9% based on the type of their income. Now, corporate tax registration, whether free zone entity is earning qualifying income or other income, is required to register itself for the purpose of UAE corporate tax law and do the necessary filings and compliances. Now, what is qualifying income? As we mentioned earlier, it has not been specified in the law as of now, but in the draft regulation, that is public consultation document, we were given a hint that this kind of incomes may be subject to 0% tax. And accordingly, this income, if we are earning such kind of incomes, it may be subject to 0% tax, and it may be due to the qualifying income. Which kind of incomes can you qualify as a qualifying income? So income from a transaction with business located outside of the UAE, transaction with business located in the same or other free zones, income from certain regulated financial services directed at foreign markets, passive mainland income, that is royalty, interest, dividends, and capital gains, and free zone person in a designated zone with a mainland goods related transaction if the mainland entity is importer on the record, and group related mainland transaction. This kind of income may be specified as qualifying income, but yes, before we take any call, we will have to wait for the cabinet decision, which will specify exactly which kind of income can be considered as a qualifying income. Also, we understood that for a entity to become a qualifying free zone entity, one of the important condition which needs to be fulfilled is maintaining an adequate substance. We all know that economic substance regulations are there in the UAE. So fulfillment of compliance with economic substance regulation would be key if the entity wants to be qualified as a qualifying free zone and wants to take the benefit of 0% corporate tax on the qualifying income. Now, the question which is important, which is of utmost importance for us is, what will be the tax implication of doing business with RAK ICC, within RAK ICC, other free zones, UAE mainland or outside the UAE? This analysis will depend upon, again, whether we are a resident or a non-resident, whether we are a free zone entity, and whether the income which I am earning is a qualifying free zone, is a qualifying income or other income. Based on this analysis, this can be answered. Presently, we are awaiting a clarity on this, and accordingly, once the cabinet decisions are, you can say, announced, this analysis can be performed. Now, taxability of family foundations or trust. So this is also, we see a couple of family foundations and trust, maybe you can say there in the RAK ICC. So what will the taxability of those trusts? So as per the corporate tax law, they say trust means any foundation or trust or similar activity fulfilling the prescribed conditions, such as it is for the trust and foundations are established for the purpose of benefit of natural person or public, and does not conduct business or business activity. These are the key conditions which needs to be fulfilled. If you are doing that, then you are a foundation or a trust which are recognized in the UAE. Ideally, if they are not doing a business activity, may not be subject to UAE corporate tax law. However, certain trusts and foundations are independently incorporated. That's a separately formed trust or foundations. If that is the case, then it will be subject to tax independently at trust level or foundation level. However, there is an option by which such kind of trust or family foundations can elect to be treated as unincorporated partnership. Now, what will be the tax impact if the trust or foundation elects to be treated as a unincorporated partnership? We'll now understand that as well. So unincorporated partnership effectively is not taxed, is seen as a legal entity, and accordingly it's not taxed independently. So in a nutshell, who all are the partners of that unincorporated partnership will be taxable on the income of that unincorporated partnership in their share of profit. So effectively, for a foundation and trust, if an election and you can say application is made to be subject to tax as unincorporated partnership, then and if that application is approved by the Federal Tax Authority, the trust and foundation will not be taxed independently. However, the beneficiaries would be subject to tax on the income, and that would be depending upon whether it's a natural person or a legal entity, and the taxability will have to be determined accordingly. So yeah, we have already answered this question, whether offshore trusts or family foundations are subject to corporate tax in the UAE will depend upon whether we are separately incorporated or not, whether we are making an election application to be treated as an unincorporated partnership, and if yes, whether the partners are legal entities or an individuals. Because for an individual, the income only which is relating to business or a business activity would be taxable. However, for a legal person, entire income would be subject to tax. Now, there are other key aspects of the UAE corporate tax law. We will quickly cover in brief. Tax group. We all are aware that for the purpose of VAT also, there is an option for a taxpayer to form a tax group. Similarly, for UAE corporate tax law also, there is an option for forming of tax group. However, the condition needs to be fulfilled. If the conditions are fulfilled, then only the tax group can be formed. What are those conditions? So basically, the one basic condition is that holding company and the subsidiary company or subsidiary companies needs to be a resident legal person. Means only UAE companies can form a tax group. And the minimum shareholding within the holding and subsidiary company should be of 95%. Another important condition is those entities should not be an exempt entity which are not subject to tax, or a free zone entities which are subject to 0% corporate tax law. If we can form a tax group, then the benefit is that you will be treated as a single taxable person. Only one corporate tax return will be required to be filed for a group and not at individual entity level. And the income of the group will be determined. This is the consolidated income of the group, all the entities, and eliminating intergroup transactions. So this is the way the person can form a tax group. However, this will depend upon various, you can say, aspects to be considered, whether which entity is having loss, profit, which kind of transactions are there between the group entities. And the major benefit, if a person or the group of entities can form a tax group, is that transfer pricing provision may not apply, because since the intra-group transactions are eliminated, the transfer pricing provision will not apply there. Now, what are those provisions? We will see subsequently. Tax loss relief. Assuming a person has not earned a taxable income, but there is a tax loss in a particular year, what happens to that tax loss? So as per the UAE corporate tax law, a person can carry forward that tax law for a future period. And whenever in the subsequent period, there is a taxable income, this tax loss can be set off, or the relief can be claimed against that taxable income, by which the taxable income of subsequent period will be reduced, and only the income which is remaining after set off of loss will be subject to tax. However, the condition is that only 75% of the taxable income of subsequent year, only to that extent, only the tax loss can be claimed as a relief. Balance what remains can be carried forwarded, and there is no time limit to carry forward the tax loss. So it can be carried forward for indefinite period. Only the condition is that the shareholding of the taxable person or an entity remains at least 51% same throughout the period. That means from the period when the tax loss was incurred up to the period when the tax loss has been set off. If this is not fulfilled, at least the similar business or business activities continued. If these conditions are fulfilled, the tax loss can be carried forward and the relief can be claimed in the subsequent period. There is another important aspect in the UAE corporate tax law, that is the tax loss transfer. This is a unique feature of UAE corporate tax law. If there is a taxable person who has incurred a tax loss, and there is another taxable person who is having a taxable income, then the UAE corporate tax law allows the set off of the taxable income of one person against the tax loss of one person against the taxable income of another taxable person. So here the taxable person are two different persons, still the tax loss set off is allowed. The condition is that the minimum shareholding in both these entities, either one is holding in another at least 75%, or there is one entity which holds at least 75% in both these entities. Then none of the entities are free zone entities, exempt entities, both follow the same financial year, accounting standard, those conditions are there. If those conditions are fulfilled, the tax loss transfer would be allowed between two different taxable persons. I referred the earlier transfer pricing provisions when we discussed about tax group. Now, what are those provisions? So basically, it says that if you're a group of companies, then any transaction between your group companies or any transaction relating to shareholder or director needs to be at arm's length. What is the meaning of arm's length? In general sense, it is nothing but a price or a value at which the transaction will happen with a third party, under a third party. So whatever transaction you do with your related parties or a shareholder, director, or other officers needs to be at the value at which you will do that similar transaction with a third party. That value needs to be determined and the transaction needs to be at that value. In case I do not have the transaction at that value, then while calculating taxable income, I will have to make the adjustment. Either may I have to increase my income or may I reduce my income accordingly. Now, this transfer pricing provisions are applicable for group related transaction, shareholder, director. Also, the important aspect is whenever my tax, whatever my first tax period, I will start with the opening balances. Whatever opening balances I have, those opening balances needs to be aligned with the transfer pricing provision. So for me, if the tax period is starting from Jan 2024, the opening balance as on 1st Jan 2024 should be aligned with the transfer pricing provision. So effectively, it would tend to give a hint that at least for me, maybe the financial or a tax period will start in 2024, but I will have to start this transfer pricing analysis and exercise in 2023 itself so that my opening balances are aligned. Now, there is another important aspect in the UAE corporate tax law, that is a GAR, General Anti-Abuse Rule. Considering that I may start, the first tax period may start for me from Jan 2024, there's a possibility I may try to structure my transaction so that effectively my tax liability is reduced. But if my such kind of activity is being undertaken only for the purpose of corporate tax benefit, then the FTA has an authority to disregard that arrangement and tax me as if that transaction never happened or that arrangement never happened. So that's why if I do any activity or a restructuring, any kind of arrangement, which is not supported by a commercial or an economic reason, then, and the whole motive of doing that arrangement is corporate, it to take the corporate tax benefit, the GAR provisions can be invoked. There are a couple of other provisions relating to compliances is that taxable as well as exempt persons are required to maintain all the records relating to their businesses for 7 tax period after the end of the taxable period. That means effectively, I will have to maintain the documents for 8 years. Financial statements are required to be prepared based on the accounting standards generally acceptable in the UAE, and entities are free to adopt the accounting standards which are applicable to them, but which are accepted in the UAE. And also certain category of person may be subject to audit. Presently, this has not been specified. A cabinet decision will specify which kind of person, whether taxable or exempt or a free zone person, which will be subject to audit. Now, we understood the provisions. Now, the important thing is how to determine the taxable income, because I will be paying tax on the taxable income. So how to come to the taxable income? Basically, I will have to take the base of accounting profit, which I am determined based on the financial statement. Certain adjustments are required to be made with respect to expenses which are not allowed. I will disallow those expenses, and that way I will determine the taxable income. So which kind of expenses are allowed while I calculate my taxable income? So they say any legitimate business expenses which are revenue in nature are allowed. So this is just a general thing. Any expense which I incur for the purpose of business is legitimate, I will get the deduction. Fees paid to local or federal government, irrecoverable input VAT. We know that for a VAT, there are certain inputs which are not allowed as a credit. If I'm not allowing those input credits are not allowed, at least for the purpose of UAE corporate tax law, those credits can be claimed as a business reduction. The next is expenditure incurred with dual purpose. There is an expenditure which has an element of business as well as personal, such as car, mobile expenses. Then I will get the deduction only to the extent of business use, and to the extent of personal use, the deductions will not be allowed. Entertainment expenditure, any expenditure which are incurred in relation to meal, accommodation to customer, supplier, or other expenditure, we are considered as an entertainment expenditure. If I'm incurring such kind of expenditure, only 50% will be allowed as a deduction. Now we will also understand which kind of expenses are not allowed. So basically, these expenses I will have to add back to calculate the taxable income. So which kind of expenses are those? So donations, grants, or gift to any entity other than a public qualifying benefit entity. If I am giving a donation, gift, or grant to a public benefit entity, that would be allowed as a deduction. But other than qualifying public benefit entity would not be allowed as a deduction. Bribes, fines, penalties will not be allowed as a business deductions. Dividend paid by UAE companies, basically dividend is an appropriation of profit and not an expense, and accordingly cannot be claimed as a deductible expenditure. Corporate tax, whether in UAE or paid any other country outside the UAE, will not be allowed as a deduction. However, an entity can claim a credit of those taxes that we will see when we'll see the example of how to calculate the taxable income. Input VAT recoverable. VAT input which is allowed as a reduction while we calculate the VAT tax liability. Since we are already claiming the credit when we determine VAT liability, those VAT which are recoverable, input VAT which are recoverable, will not be allowed as a deduction. For an interest expenditure, there are certain specific conditions which need to be fulfilled, and accordingly, if our interest expenditure is not fitting into those conditions, then we will have to partially or fully we may have to disallow those expenditures. So what are those rules? So there's a general rule, there's a specific rule. So general rule is that any interest expenditure in excess of 30% of EBITDA, that means earning before interest, tax, depreciation, and amortization, excluding exempt income. If I incur any expenditure, net interest expenditure, basically interest expenditure minus interest income. If I incur net interest expenditure in excess of 30% of EBITDA, that excess will not be allowed as a deduction. However, it's not a permanent disallowance. Excess amount which I'm not getting as a deduction will be carried forward for a future 10 tax period, and I can claim the deduction in those 10 tax periods. This is a general rule. This general rule will not be applicable if net interest expenditure does not exceed certain amount, which this threshold is yet to be notified. And so we'll have to wait for a cabinet decision here. And also this rule is not applicable to banks, financial institution, because obviously the money lending and all is their business. There's a specific rule is that in case I have an interest expenditure relating to a borrowing which I've taken or a loan which I've taken from a related party, and that loan has been used to fund an exempt income. That means if I use that loan to give a dividend or other profit distribution to a shareholder, that dividend may be exempt in the hands of individual. And accordingly, if that's happening, I will not get the deduction of that interest expenditure while calculating the taxable income. So entity will not get the deduction. So effectively, time limit for claiming expense basically for a VAT is better. At least we are getting 50% expenditure for entertainment. Interest expense, whatever is incurred, we'll have to see whether are we fulfilling the condition or is there any excess expenditure which we need to disallow. Certain provisions were there in the UKC which are there in the corporate tax law, but were not there in the public consultation document. Those are proportionate deduction for expenditure with dual purpose and expense carry forward of excess interest, net interest expenditure for 10 period, tax taxable period. These were not there in the public consultation document, but yeah, these are good provisions, and we see those provisions in the UAE corporate tax law. So next, we will now see how to calculate the taxable income. So we will start with the accounting net profit as per financial statement. We will make the adjustment for expenses which are disallowed. We will claim reduction for income which are exempt, and that way we will come to the taxable income. So accounting net profit 1 million dirham. Now I will make an adjustment for unrealized losses which are not allowed. I will claim an exemption or a reduction for an exempt which is not taxable. So accordingly, I will reduce my income. I will again disallow expenses which are not allowed. Say for example, expenditure of personal nature or an entertainment expense. I will disallow that. Adjustment for a transfer pricing related, basically transaction with related parties. If not, it's arm's length, I will make that addition. That way I will come to a taxable total income. So my taxable total income and my accounting profit is different. So this will be, in almost all the cases, we'll see this difference. And on my taxable income, up to 375,000 dirham, I will not be paying any tax. In taxable income in excess of 375,000 dirham, will attract a 9% tax. In this case, it will be 76,500 dirham. Here, I will claim the credit for foreign taxes. So any taxes paid in foreign country, I can claim a credit if the income is included in the taxable income. I will claim that credit. In this case, we are taking that as a 10,000, and net final UAE corporate tax liability, which I will have to pay, comes to 66,500. Now there are a couple of compliance provisions we'll quickly cover. Registration. All the taxable person, including free zones, are required to register for corporate tax and obtain the corporate tax registration. The time limit is before filing the first corporate tax return. So we have a time up to filing of for corporate tax return, we can take in registry. We take the corporate tax registration. There are no thresholds. So each and every taxable person is required to obtain a corporate tax registration. Even if we are having a VAT registration, we will have to separately take a corporate tax registration because both these taxes are different. And when an entity cease to continue the business activity and is wind up, then the registration is required to be surrendered. Or basically the registration is required to be obtained. Corporate tax return. A taxable person is required to file its corporate tax return within 9 months from the end of the taxable period. So if for me the first taxable period is Jan to December, then Jan to December 2024, I will have to file my corporate tax return up to September 2025. So basically 9 months from the end of the taxable period. Also, I may also be required, if I'm subject to transfer pricing provision, I may also be subject to transfer pricing filings, but this will be notified subsequently. Tax payments. A taxable person having a corporate tax liability need to make that payment within 9 months from the end of the taxable period. It's the same timeline which we have for a filing of corporate tax return. Presently, there are no advanced corporate tax payments are required. In case there is an excess corporate tax payment, then the person can claim a refund of the same. Next is tax credits. While calculating my corporate tax liability, I am allowed to take reduction, basically credits for taxes paid in the UAE as well as in foreign countries. However, for taxes paid in foreign countries, I can only claim a credit up to the extent of the tax, UAE tax payable on the foreign income and any excess. So for example, I've paid a 10 as a foreign tax in the UK. And in UAE, on the same income, I'm subject to tax at 9. Then I can claim only credit up to 9. That one balance one amount cannot be claimed as a foreign tax credit. Neither can be claimed as a refund. Assessment, only taxable person or other person, exempt persons or free zone entities may be subject to assessment, but the provisions will be notified subsequently. Now, after we understood all the important basics as well as important key areas for corporate tax legislation, now it's important how do we prepare as a business or as an individual, how do we prepare for corporate tax and how do we travel that journey? So for this, I will request Girish if he can kindly share his perspective how to travel this journey.
Okay, I think thank you, Nirav, for the detailed presentation. I think in the interest of time, I'll try and keep it very brief. Nirav, if you had put the fourth slide. Next one. Okay, I think primarily just to summarize this slide as such, why bother now? I think looking at the provisions that Nirav highlighted, okay, it's very, I think it's pretty clear that the journey needs to be starting yesterday, okay, because there are things like, transfer pricing, which would be applicable effectively for the previous year as such. And obviously, when you talk about it, direct tax is new, you need, you have no prior experiences, accounting and auditing requirements are something which can be improved. Okay, main is, I think from a structuring perspective, basically organizations need to look at, okay, how do they want to structure, whether in terms of forming a tax groups, okay, whether they need to take as a free zone, take the option of opting for 9%. There could be various considerations for that. I think important part of it is there is an impact of 9% or greater on your bottom line, right? So that is something which is very, critical for organizations to consider. Move on, Nirav. Okay, and these are the risks you should avoid, that you don't have enough time, you do not understand the legislations, your control systems are not built for, in terms of, basically for corporate tax. So these are something of the risks that we need to avoid. Move on. Okay, and general methodology that we are suggesting is that there are 4 pillars, primarily from structure perspective, looking at if there is any system related changes required. Okay, they're analyzing your transaction, like Nirav mentioned, whether you have disallowables, what is the extent of impact for foreign tax credits and those things. And more importantly, in case of larger organizations, it is about, how do we handle the training and communication, right? This is what we recommend as a broad implementation journey. I think we are today at the stage of where we can easily conduct the preliminary impact assessment. Once the cabinet decisions and all are out, that is where we are looking at organizations possibly doing the detailed impact assessment. And then subsequently, once the impact assessment is done, then we move on to the implementation phase. And primarily then we are, kind of looking at the return filing phase. And this is considering a journey of an organization which has its financial year from January to December as such. Okay, this is the last slide on our presentation. Just a very quick overview of our company. We are here for the last 14 years. Very simply put, we basically cover right from an establishment of a company, right to, God forbid, the liquidation of the company, and in between any kind of professional advisory, whether in terms of accounting, auditing, right, internal audit, due diligences, M&A, right, structuring. These are all the domains that we handle, and we are present in 5 countries, UAE, Oman, Bahrain, KSA, and Qatar. And I think with that, we come to the end of the presentation. Lara, hopefully we...
Thank you.
Yeah, no, thank you very much. Really appreciate that, Nirav and Girish. A lot of detail there that is so important for us to get a good understanding. And I really thank you for explaining what we know at the moment, but also what we don't know yet. And it's as equally important to understand that there are those questions that are still unanswered, which leads me into Q&A, and I appreciate we're out of time, but very quickly, we had a question on rental income from properties, whether it will be treated as UAE sourced income.
Yeah.
If it's exempt.
So I think we go back to in terms of, I think every time we have to look at this analysis of primarily, what is it going to be, what is in the offshore entity going to be considered at? Okay, and I likelihood if it is considered as resident, as Nirav pointed out, the worldwide income is taxable. Okay, even if you take the scenario that you're considered as a non-resident, even in that scenario, effectively any UAE sourced income is taxable. So I believe the boiling question is always that, where you have offshore entities and they have got rental properties in UAE, right? Would it be taxable? So I think the answer lies in whether it is a UAE sourced income.
Sure. No, thank you for that. And then also similarly, whether RAK ICC would be treated as free zone. Now, interestingly, one of the requirements was substance, and we know we'll need to look at how the free zone requirements and offshore substance combine.
Yeah. So just to add to what you said, Alan, primarily, I think what we have seen is that each time for each of the legislations, the definitions are important, right? And what they have basically said is that as far as the free zone, the definition has to be, specified in a cabinet decision. So we need to see whether it will basically just consider a free zone, a financial free zone, or it will also incorporate the offshore entities. Now, if it is going on the free zone route, then we basically have what we say that, then the second thing is about the qualifying free zone. And as you said, it is about the substance and, whether you opt to take it, right? You fulfill the requirements as such, right? So then you'd be a qualifying free zone. Once you become a qualifying free zone, then we talk about qualifying income and non-qualifying income.
Sure. Understood. So yeah, no, we're absolutely clear. We need to wait for the next issue of the decisions. We've had the comment on whether the presentation's available. Yes, we certainly will make it available. And one other question on intercompany loans, whether the intercompany loans without interest are violating the arm's length rule. Any thoughts on that?
You take this.
Yeah. So yes, intercompany loans between it will be considered as a transaction with related parties. Obviously, we will have to evaluate this from the transfer pricing perspective. Ideally, if I am giving a loan to any person, obviously a person will expect an interest in return. So if you are giving a loan without an interest, definitely that will be require some changes because that will be subject to transfer pricing provisions.
Understood. And then there's a question also about funds injected into a company and whether they would be treated as taxable income. I'd assume not, but yeah, understood. Thank you.
Yeah.
And we've got a question on economic substance and whether offshore companies that meet the economic substance requirements can choose to be tax residents in the UAE. And again, my assumption is every company that's incorporated in the UAE is effectively tax resident, and then you have to go through the rest of the rules. Is that right?
Yeah.
Yeah.
You're perfectly right.
Yeah. Okay, thank you. Well, I think that answers the questions. Please don't hesitate to contact Lara or your relationship manager if you've got anything else that you'd like picked up on. Obviously, RAK ICC are not the tax experts. We'll follow up with more information as we have it. Any other closing remarks, Lara?
Yeah, thank you, Alan. Thank you, Nirav and Girish, for the insightful presentation. We thank also everybody for being here. Thank you for your time. And I hope you find this webinar informative and addressed most of your questions. And thanks again for joining us today. And we'll see you next time. Thank you.
Thank you all. Appreciate it.
Day.
Thank you. Bye now.
Thank you. Bye.